Hi, everyone. Thanks for joining and welcome back to Wall Street Silver. Today's guest is Michael Gentile. Michael is a strategic resource investor and has been a fund manager for more than a decade. Thanks for joining us, Michael.
Thanks, Ivan. Great to be back with you.
Yeah, absolutely. We've seen all these major banks like Goldman Sachs, among others. They came out this month and they're raising gold price targets to 2,500 by the end of the year. Do you think that's a reasonable target?
I think we're in store for new highs for gold for sure by the end of the year. I've been on your show a few times, Ivan and Jim. Thanks to having me back again. But I remember laughing about transitory inflation with you guys about 18 months ago and how the Fed was out to lunch and they were completely missing the boat on inflation. I remember coming back on and saying, by the time the Fed gets serious about fighting inflation and they start raising rates, they're going to cause serious havoc in the markets. And that's unfortunately for all of us who own stocks have come to pass in a dramatic way the last 3 to 6 months. But I also said that the act of the Fed actually starting to fight inflation, while it's going to hurt in the short term, and our portfolios are all feeling the pain from the result of those actions, was actually what we needed to set the stage for gold to make new all-time highs. So I'm actually very excited by what I'm seeing, very constructive by what I'm seeing, because the playbook's kind of unfolding as I hoped it would. Now, the mark-to-market's not fun, the stocks being down is not fun, but the reality is I think the Fed is very, very close to causing a major train wreck or having to pivot or pull back. And we can talk about reasons as to why I feel that way. But the second the Fed clears their throat or sort of mentions to the market that their hiking cycle is almost done, and I feel they're pretty close to that maximum point of hawkishness right now, that's when gold's going to really take off. And so I do feel very constructive about gold in the back half of the year. I do think gold's going to make new all-time highs in the back half of this year into next year. Couple that with how terribly the stocks are trading right now provides a pretty incredible entry point opportunity for investors that want to put some capital to work in the gold sector right now.
Mm-hmm.
Well, one of the charts that was really interesting recently on Twitter, a guy named Happy Hawaiian put this out there, and it's been, hugely popular. He told me this was his best tweet ever, I think. But this graph is really interesting, and I wanted you to talk about it. Let me enlarge it for us.
Yeah.
Walk us through this and why it's important.
Yeah, so as sleepy as the Fed was when they talked about transitory inflation, I think they're equally asleep at the wheel here when they think that they can just raise rates 75 basis points at a shot without causing havoc in the financial markets and the global economy. And I've talked to you guys before about my US debt thesis, which is very simple math. I'm a simple person. $30 trillion of debt, doesn't go away. And so when rates are zero, your servicing cost on $30 trillion of debt is pretty close to zero. When interest rates go up to 4 or 5%, where the Fed thinks they can take them, well, that $30 trillion of debt now costs you $1.5 trillion a year just on interest. And just for your viewers' knowledge, the US took in about $3 trillion of revenue, tax revenue in 2019. Any company, any individual that has 50% of their revenue going to just service the interest on their debt is pretty much insolvent. So this graph here, Jim, just shows you as the debt has increased, right? Every time that the Fed raises rates too high, this is the 5-year yield and the Fed fund rate. That's basically the blended cost of debt, short-term and medium-term debt financing for the US government. When that gets too high and multiplied by the national debt, you have a crisis. And you can see the different crises. We can go through each of these crises: the dot-com bubble, the housing bubble, the 2018 mini crash when they tried to raise rates. This happens. It's pure math. Interest, debt doesn't go away. Interest costs eat things up, and it eats up the consumer's wallet, it eats up the federal government's wallet, and then forces them to pull back because they don't have the money to spend on essential services or their personal budgets as consumers would have. So this is a very powerful chart. And you think about them hiking 75 basis points in 2 weeks, they're going to blow right through that blue line, right? So we're going to be in new uncharted territory in terms of the strain and pressure they're putting on the system with these rate hikes, which is why I feel they're very, very close to the end of the hiking cycle here.
Well, in 2018, or maybe it was 2019, that was the end of we're watching the paint dry phase when they tried to tighten last time. Mm-hmm. And the peak in that cycle on the Fed funds rates was like 2.25%. Mm-hmm. And correct me if I'm wrong, but was the reason that they stopped raising was the high yield bond market just froze up, right? Nothing was being issued for like a month or two.
Right.
And basically the gears of the financial system were freezing. Are you seeing signs of that happening again right now?
You see it live in real time, right? The high yield market's effectively closed right now, or is in chaotic. Emerging markets are blowing up as we speak. Europe is in total meltdown mode. The euro hit parity with the US dollar today. It's not a good thing for the global economy. Equity markets are slammed shut for all but the strongest of issuers. So your capital markets are starting to freeze up. Your global economy is slowing down. Regardless of what the economic numbers say, you just do simple logic. The consumer is getting poorer and poorer by the day with all the pressure that's being put on the consumer. So the economy is rolling over, the capital markets are starting to freeze up, and yet they're continuing to have this mantra, we're going to fight inflation with everything we got. It sounds really familiar to inflation is transitory, right? Talk is cheap. When you start to create massive havoc in the markets and people's economies and balance sheets, at some point you've got to stop. And so we're getting very close to that point.
The euro reaching $1 is an amazing event that hasn't happened in 20 years, almost to the beginning of when the euro started. It was in the late 90s, used to be below parity, but it's been consistently 110 to 120 for so long. You know, what does that tell you about the euro coming down to parity again? Is the euro done? Is it because they can't raise rates, they can't fight inflation?
I think there's another chart that I sent you guys want to talk about, but the dollar strength, the DXY. So the US dollar is making new 20, 30-year highs, not because the US is a pristine, well-financed economy with a good currency, a stable currency backing, but it's really the best house on a really terrible block, right?
So this is the DXY chart that you were referring to, Michael. What should we be paying attention to here in relation to the euro?
Yeah, well, in context for Ivan's first question, why gold has been soft recently has been the DXY has been relentless. US dollar has been making new 20, 30-year highs, against all global basket of currencies, against the yen, against the euro. And so it's not so much the euro's done or the yen is. I think the US is the best house on a terrible block. The US is in a tough position, but they're in a relatively stronger position than Europe, which is a very bad position. Europe is facing ripping energy prices due to the conflict in Ukraine. So your energy prices are through the roof. The supply chain problems are massive there, and the economic strength of their balance sheets are weaker to start off with. So their ability to withstand these stresses are low to begin with. So the euro hitting parity is not a good thing. And this chart just shows you that the bears on gold saying, well, the US dollar is going to keep going higher. Well, again, similar to the other chart we had about debt and interest rates, when the US dollar moves this much versus the basket of global currencies, you can see all the red highlights at the top here. This type of move typically causes a major global meltdown somewhere, whether it be a debt crisis, global financial crisis, housing bubble, tech bubble. These things can't operate in vacuums, right? The US dollar goes up, it causes enormous strain on emerging markets and other economies, becomes much more expensive for them to buy goods, puts a lot more pressure on their consumers. So the US dollar, interest rates, all these things are really maxed out, kind of pointing really high right now. Eventually something breaks, and that breaking point is close, I think, at hand. That's what's going to cause the Fed to pivot, whether it be Europe crisis, emerging market crisis, a housing crisis, a market meltdown. Those are all things that are happening in real time that are going to cause, I think, the Fed to reconsider in short order what their plans are.
And that's when gold and silver go to the moon, right?
Correct. You're going to choose between fighting inflation and causing a massive depression or causing a massive global mishap. And that's typically to get the tap on the shoulder from the IMF or one of the other central banks saying, look, you go any farther here, we're toast. We can't go this is causing too much strain on our system, our banking systems, our economies are collapsing. The Fed can't operate in a vacuum. They can't only think about US. They might have to tolerate a higher level of inflation that they're comfortable with. So lower real negative rates, we've talked about in the past, in order to keep the system afloat, the global financial system afloat, not just the US, fighting inflation with tunnel-like vision.
Along those lines, Luke Groman on Twitter just wrote this the other day in response to US Treasury Secretary Yellen and the Bank of Japan's were cooperating on Forex issues as appropriate. And Luke was making the comment, the US dollar's crushing our allies in Japan and Europe far faster than the intended targets, which I assume is he's making reference to Russia. This is what you're talking about. The DXY is incredibly strong and it's killing our allies and crushing their economies.
Correct. I mean, they're already dealing with massive energy prices, supply shortages, crippling, issues in their economy. The US dollar going up 1% a week is like kicking them in the teeth every single week when they're down and desperate for help. So, I remember if you guys saw 3 weeks ago, I think the ECB, just when the rates, like after the first 75 basis point hike, the ECB called an emergency meeting to deal with the peripheral European states, the Italy's, the Greece's, the Portugals of the world. I mean, the Italian bond yield was only 4%, and they're already calling an emergency meeting to deal with how they're going to deal with this. It shows you how unequipped the European economies are to deal with higher rates, even less so than the US. So by raising rates here, it puts even more and more pressure on those yields in these peripheral European countries that can't afford the interest on their debt either. So we're all intertwined, and we all can't afford the rates that they're trying to push into the economy to slow inflation. Again, which is, I don't sound like a broken record, which is why I think the Fed is very close to having to pivot here.
And this is the other chart that you emailed to me. Monthly mortgage payment based on median existing home prices. This looks, this looks bad. Explain it to me.
Sure. So we talked a lot about the macro and the pressure on the federal government, the European governments. That's all big picture where the central bankers get together and go, look, we're creating a massive problem here. But the micro level, which is a lot easier for your viewers to understand, and why I think the economy is slowing in real time, and why, again, the micro level, the US economy is 70-80% consumer driven. So what the consumer health and what the consumer is doing is extremely important for the US economy's health, and will dictate what the Federal Reserve does with future rate hikes. Think about what's most important to consumers: having a place to sleep and put their head at night, and filling their tummies with food, right? So those two things right now, if you're a consumer, and then driving to your work, wherever you drive, wherever you work, you probably have to drive and put gasoline in your car. Those three things have gone through the roof. So if you're a consumer that wants to buy a house or find lodging, a year ago, your average monthly mortgage payment was $1,000. If you go to buy a home today, it's $1,800 to $1,900. That's an 80 to 90% increase in your monthly lodging costs. So that's huge. Most people have their housing costs 30 to 40% of their monthly budget. So you double that, 80% of your budget's now suddenly going to your mortgage. So that's unsustainable. So either you're trading down to a smaller house or you're in financial distress. Yeah. So then you go to the grocery store and you see where grain prices, wheat, corn, and soybeans are all up anywhere from 100 to 120% over the last 6 to 12 months as well. So your mortgage payments are probably doubled. So that's eating away at your disposable income. Your food basket at the grocery store is up anywhere from 30 to 100%, depending on what you're buying. And then finally, if you want to drive to work, you're filling up your car with gasoline that costs 100% more than it did, a year ago. So the disposable income of the consumer is under severe pressure. And you only have to look at the quarters from Target and Walmart that came out about 3-4 weeks ago. They both missed their quarters. They both had a similar refrain. They said the percentage of consumers' basket going to food, the necessity, eating, right, went way up, and their disposable income to clothing, DVDs, hard goods, whatever that is, went way down. And therefore the margins on food are much lower than they are on the disposable items. That's very bad for the economy, right? Because your disposable purchase, your vacations, your restaurant trips, your big screen TVs, all that stuff that drives the economy, there's less and less money the consumer has to spend on those things. So the Fed's looking at backwards looking economic data that still looks okay with some softening. The forward looking data is going to accelerate dramatically the downside because the consumer just doesn't have the money to spend on what he was spending a year ago or 18 months ago. So that's just numbers, again, logical numbers coming through saying the economy is going to slow down. So rising rates into a slowing economy also is a pretty toxic recipe because you're going to be putting more pressure on the consumers that are already feeling quite a bit of pressure today.
I've been speculating, and I wanted to get your opinion on this. If we're in the next GDP number comes out on July 28th, and a lot of people are expecting to be negative, and so then we're in a recession, 2 quarters in a row, negative GDP. You think Congress then comes out with what they normally do when we're in recession is more food stamps, more unemployment insurance, maybe even stimmy checks. Right. And we've got a congressional election coming on in November. Would you be expecting between now and November Congress to maybe try to do some sort of emergency funding stimulus for the recession?
They can try, but pull up our Happy Hawaiian tweet from earlier in the show, and you'll see that their ability to finance that. Where's the money going to come from? Right?
Well, the Fed has to change, right? And essentially finance it.
We've already talked about half of their revenues now going to interest payments if they keep rates where they are, right, going forward. And so they'd have to print new money or have much larger deficits in the future. You can only finance those deficits if you're printing money. Back, hello QE, hello suppression of interest rates. So again, that's feeding back. We're coming to the same conclusion again and again. But the theme of this interview is the Fed has to stop or pivot at some point in time, the next 3 to 6 months, because the numbers just don't add up, and that's simple to get your head around.
So, Michael, you're most known for, as a very successful stock picker. So I had to get your opinion on a couple of the stocks you're really positive about these days in this environment. And one of the ones you really like is a uranium play called Kraken Energy. Tell us why you like this one, why it's important.
Yeah, I mean, I think that we talked a lot about macro so far in the show, and I think we didn't touch uranium yet. But if you look what's happening in Europe with the energy crisis they're facing there, Germany's back to burning coal, which is unbelievable when you think about how against it they've been the last 10, 20 years.
And the Green Party's part of their current ruling coalition, and they're going back to coal.
So the Green Party's burning coal. Things are really dire for energy security in Europe. So uranium made a lot of headlines recently. Almost every single European country to a T has come out and said uranium has to be a big part of our future. They're naming it a green, priority fuel up there with wind and solar. So the macro backdrop, market volatility aside for uranium is fantastic. And my issue with the uranium sector over the years, I've had a hard time finding names that are appropriately valued versus the uranium price. And so Kraken Energy is one that I really found quite attractive. It has very high grade, which is very important to me, great jurisdiction in Nevada, and significant running room to expand the size and scope of the deposit. And with the security of uranium becoming really important of where it is, because countries realize that countries aren't as friendly as they used to be and secure and stable as they used to be in terms of supply, the company is extremely well positioned to benefit from these great tailwinds that uranium I see for the next 5 to 10 years for uranium. And the valuation, was cheap when I bought it. It's compressed by about 50% in the last 3 to 6 months with the sell-off of the market. So it's even cheaper than it was last time we spoke about it. Company is very well financed. They've got about $12 million cash in the bank, which is also very important in these markets to be well financed. So company's in a great position to start their maiden drill program and really start to show the size and scale and the value of this significant high-grade strategic deposit in the US for uranium.
Another one you like, if anyone's interested in gold and silver, is American Pacific Mining Corp. Why are you so positive about this one?
It's a name I've liked for a while. They've got a lot of the attributes I look for in a story. Very solid management team, both in terms of capital markets and geological expertise. They have Warwick and Eric do a great 1-2 punch there in terms of management. They've got high grade projects, so it's really important. To high grade equals high margins and desirability. They've got 3 high grade projects: Madison, which is a joint venture with Rio Tinto, gold, copper, silver, very large scale, very exciting. $20 million to be spent by Rio Tinto on their dime without any dilution to American Pacific shareholders. And they've got a high-grade silver project, which is Gooseberry, which you have on the screen here now, and a high-grade gold project in Tuscarora. So lots of optionality. A well-financed company, again, similar to Kraken. They got about $13 million in cash, and the stocks come off, I think, 70 to 80% off the highs, despite being well-financed and having very high-quality projects and a good team in place. So these are all projects and stocks that are going to rebound really nicely if our Fed pivot thesis is correct. They've been oversold. People are under a lot of pressure, margin selling, just our portfolio being blown up across the board. Lots of indiscriminate selling in the junior mining space, despite the fundamentals being very, very solid for gold and silver. And despite the gold and silver prices not being down that much year to date, these stocks are still down 60, 70, 80%, which, unlike the tech sector, other sectors where the fundamentals have gotten a lot worse the last 6 to 12 months, gold fundamentals remain quite positive, yet the stocks are down 70, 80%, which to me is an amazing opportunity for buyers in this market.
And another one, this one's interesting, Atlantis Gold. This is a junior producing company in Ireland, where they're about to start producing again on this project. Tell us why you like this one.
Yeah, I'm a significant shareholder of Atlantis. What attracted me to it initially was 2 things. You mentioned them both, Jim, was the exploration upside in this project is phenomenal. I mean, you guys may have heard of the newfound gold story in Newfoundland, Eric Sprott's biggest investment, multi-billion-dollar market cap story. Back in the day, Newfoundland and Ireland was one tectonic plate. So the geology in Ireland actually was Newfoundland millions of years ago, and it split. So the similar geology they saw in Newfound Gold and Newfoundland exists in Ireland. And so when I came into this story, you had a past producing mine that was kind of a mom and pop operation running hand to mouth, didn't have the money to get back into production, but with compelling exploration upside, only drilled to about 200 meters deep. Very high grade veins. Mario Stefano came in, new CEO. They recapitalized the company. Myself and Eric Sprott came in as investors to the story. They've drilled some really exciting exploration results the last kind of 3 to 6 months. Your viewers can go pull up those results, which kind of validated the significant upside I see here. And the most exciting news happened a couple of weeks ago. They announced that they just started stoping and production to get the mine back into production. This is going to be a rare story, which is going to be a junior microcap stock with about a $40 million market cap that's going to be producing cash flow, while at the same time drilling exploration holes that could double, triple, quadruple the size of the existing resource with some good drill results. So the nice combination of cash flow, exploration upside, now a new good management team, and a much better financed operation is quite a good entry point. Again, this stock is down, 50% off the highs in the last 3 to 6 months.
And the last one I wanted to ask you about is a company called Arizona Metals Corp. What is it about this one that has you excited? Why should people be paying attention to it?
Yeah, I publicly said I own about 20 junior exploration companies. And the reason why you invest in the sector, try to invest in $10, $20 million market caps, is to make these, true tier 1 world-class discoveries. And, I've been doing this for 20 plus years. I can say honestly that Arizona Metals is one of the best discoveries I've seen hands down in the industry. It's got incredible grades, anywhere from 3 to 6% copper grades, anywhere from 5 to 10 grams gold, over incredible widths. I'm talking 50 to 100 meter wide widths. So typically you see those grades over 2 to 10 meters, is 50 to 100 meter wide width. So they've got incredible grade, incredible width and wide scale for this deposit. It already is, to me, probably one of the best undeveloped copper gold discoveries in the world with the current footprint they have today. Most exciting part is they've only drilled 3% of their trend that they see this prospective VMS deposit being prospective for. And so they're just started drilling the central target. They're going to move west. So the next 12 to 18 months, they're going to go from drilling 3% of this to probably 50 to 60% of it. But the 3% they've drilled already is probably one of the most exciting scale VMS discoveries I've ever seen in my career. And they could be potentially finding multiples of this, K mine deposit they found in the coming 12 to 18 months with some drill success. So I think it's a logical takeout candidate in the next, 12 to 36 months. Low capex, great jurisdiction of Arizona, great place to build a mine, incredible margins due to the grade. Whatever copper price you want to put or gold price you want to put in, this mine will be profitable at making money. At $2 copper or $5 copper, or at $1,000 gold or $3,000 gold, this will be a profitable operation. That's very rare. Those are really hard to find and very coveted by the majors when they are discovered.
Well, Michael, thank you very much for joining us. We really appreciate it. I mean, you're always very popular when we have you on our channel for your macro comments and your individual stock picks. And we're definitely going to ask you back in the next few months as this develops and see what happens this crazy year.
My pleasure. I hope we're right.
I hope so too.